This episode of Macro Mondays was aired live at 12:30 p.m. BST on Monday, the 7th of October. Tune in Mondays at 12:30 p.m. UK time to watch Macro Mondays live.
Hello and welcome to another Macro Monday. My name's James Brodie and I'm Head of Learning Development here at Onyx Capital Group.
I'm James Todd on the direct trading team here, hoping to give you insight from our trading floor.
Today we'll be talking about key market data, charts and risks. We'll look back at last Friday's huge payroll number out of the US, and we'll look at also the ISM services and manufacturing data that came out. Services very strong, but manufacturing very weak globally.
We'll be looking at the European data over the past week, and particularly the weakness that we've seen in Germany. Like everyone else, we'll be keeping an eye on the tensions in the Middle East, and we will be analysing how they have impacted energy prices over the past week. And China is now back from its Golden Week holiday, so we'll be expecting a good amount of volatility over the week to come.
We'll start with the ISM Manufacturing Purchasing Managers Index. Global manufacturing is now in recession. Manufacturing PMIs have contracted for the third straight month in September. New export orders dropped globally at the fastest rate in 11 months. And data points to global trade volumes falling 3 to 4% year over year. This is the most since COVID. What we're seeing from the ISM data as well is deteriorating employment. Both services and manufacturing employment data combined came in at 46. That's contraction. It's much lower than expected and the second lowest reading since 2020. But if we look in isolation at services PMIs, these came out much stronger than expected, especially in the US, where services PMI beat substantially. It was an 8 sigma beat, with PMIs coming in at 54.9 versus a 51.5 expectation. What we saw from this is we saw yields suddenly spike and we saw the dollar spike as well. Both had been aggressively shorted by traders, and we saw over the course of the week, 2-year yields had their biggest week in 2 years, and dollar yen had its strongest week in 15 years. In fact, that was aided as well by a dovish Japanese Prime Minister, Ishiba, previously been hawkish, but last week he came out saying not an environment for additional rate hikes. So we saw a scenario of US yields suddenly going higher, Japanese yields going lower, and dollar yen surging off the back of that. And then if we move on to Friday's big employment data, the market was expecting 147,000 jobs created. In fact, the highest economist estimate was 220,000 jobs, and it came in at blockbuster plus 245,000 jobs. The unemployment rate fell from 4.2 to 4.1. In fact, it was 0.02% of falling down to 4.0.
Yeah, so this data is clearly sort of at loggerheads to the ISM data. And I think if we look at this from a surface level perspective, it's no surprise that the dollar yen movement has been what it is, because if Japan is looking less likely to increase rates, I mean, a 1%, a hike to 1% had been rumoured. If that's less likely to be going through, plus with unemployment seemingly, according to this payroll data, falling in the US, there might be less incentive for the US to make further cuts on interest rates. So, you know, this goes against some of the weakness that we'd seen on the US dollar yen currency exchange. But I think, as you'd mentioned before this podcast, James, that we should probably scrutinise this payroll data a bit further. It might not all be as good as it seems.
Exactly. This comes out at complete loggerheads, completely opposite from what we're seeing from the ISM data. But a few things to highlight. Firstly, of course, how accurate is payroll data? We had just a couple of months ago the annual revision, and payrolls revised downwards over 800,000 for the year. So we know it's not that accurate. We know we have revisions coming in. But then within last Friday's data, 785,000 jobs created were from the government sector. So the jobs being created are not private sector, but they're government sector. So this doesn't bode well for the private sector.
Absolutely. And if you look in context with elections coming up, etc., it would be well within the government's incentive to be, looking to try and bolster numbers there, let alone if you can have a headline that makes things seem better now and things are not all hunky-dory and get revised down. It might be a bit much to suggest foul play there, but certainly the reaction to some more right-leaning commentators was that we should not take this data as absolute gospel, and we should, perhaps wait to see whether this is truly reflective.
And as you say, it is at odds with everything else we're seeing. Another important point as well, a record number of people having second jobs. So 8.66 million people with second jobs. But of course, there's two ways to look at this. Firstly, we can discuss how accurate this data is. But of course, the key point for the markets is within milliseconds of that data coming out, the market reacts, and we saw yields go aggressively higher. The two-year yield has rallied nearly 50 basis points in a matter of, less than a week. So what we're seeing there is effectively it's a tightening, quite an aggressive tightening. We talk about the Fed hiking and cutting rates, but what they're doing when they move the Fed funds rate is they're moving the overnight, the very front of the curve. But what we saw last week was the two-year go aggressively higher. In fact, the curve flattened. But we even saw the 20-year move from 397 to 433. So we saw that go up 36 basis points literally in 5 days. So we're seeing the curve tightening here. And again, what does the market react to? It reacts to the headlines.
Yeah, whether the truth of the matter is there or not. There's the old adage, never let the truth get in the way of a good story. Perhaps it should be repurposed to be never let the truth get in the way of a momentum trade, because in this scenario, we have seen the headline being bought into, and we're going to look at it in the Middle East context on the impact on oil. No matter what the underlying, if that headline goes out, you see markets move.
Yeah, and if you're a trader with a position on, you can bitch and moan about how you disagree with the data, but it's the price action that determines your P&L at the end of the day.
Absolutely.
So if we move on, we had various Fed speakers during the course of the week. These actually came out before Friday's data, but we saw Fed's Powell actually, Chairman, he said the Fed is not in a hurry to cut rates quickly, will be guided by data. He was quite hawkish. Fed's Goldsby was much more dovish. He said there will be a lot of rate cuts to come. But we saw both Powell and Bostic made reference to jobs data. And the chart here, as you can see, this is the number of people holding a second job, as I said earlier, now at record levels, 8.66 million. So the employment data will still be key going forward.
Yeah, and it's not a one-size-fits-all sort of remedy. Whilst, as we started the show talking about the differences between services and manufacturing, there will be different responses taken to different data sources. And I wouldn't have thought that either Fed or either Powell or Goolsbee would be, particularly changed by this one announcement on Friday. They will be looking at everything and making informed decisions accordingly.
Absolutely. And what we also had last week, actually, change in the market sentiment. Break-even rates on US 10-year bonds are now the highest since July. So inflation fears are starting to stir again. This is with the oil price spiking, the huge stimulus out of China, also obviously payrolls, and also what else have we had? PMI services data coming out. So what is the break-even rate? It's the difference between yields on the nominal bond and inflation-linked bonds with the same maturity. Gives us an insight into what the market predicts inflation will be going forward, and that is starting to tick up.
Yeah.
What we're also seeing, a bit of anecdotal evidence out there, restaurant performance index continues to fall. Restaurants are struggling. Consumers obviously under more stress there.
I think this is one of these classic graphs and piece of data that I quite like, because I think it's probably quite reflective of the underlying situation. About a month ago, we had some decent data on website traffic for airline companies. People were less willing to be looking up and spending money on holidays. We're seeing restaurant performance index perform not fantastically. And as you said, on the payroll data, we have a good indication that a lot of people, whilst they are employed, are perhaps overstretched, and the second jobs market is really coming into effect. So these are squeaks at the peripheries of a lot of the wider data that you might see.
It's also highly correlated with retail sales, as you'd expect, and again, moving in the wrong direction. Another point we've picked up on before, US housing on a knife edge with mortgage applications now down below 2015 levels. Affordability, so house prices are now 47% higher than they were in early 2000 in the United States, but the median sale price is now 5 times the median household income.
Yeah, I think a lot of these things that we've been looking at are pointing to rate cuts perhaps being beneficial. If we were to look at this in isolation, though, on US housing, rate cuts would be advantageous to incumbent owners of property because it makes purchasing more affordable. However, if these figures for purchasing are so astronomical in comparison to the basic wage, then that makes things more tricky, and its applications might be less sensitive to an interest rate cut. And similarly, beyond just that headline of wage to house price, if we were to look at wage to disposable income per capita, that does appear to be waning, given that people are spending less at restaurants, spending less on holidays, and having to get second jobs.
Absolutely. The market, so starting to unwind its economic bearishness here. You can see the rates, interest rates, the dollar and oil all moving higher and correlating quite closely. On the flip side, though, in Europe, Eurozone, we've seen much weaker data again, some more out today actually. But last week we saw inflation falling below the ECB's target of 2%. Eurozone inflation coming in at 1.8%. And what we had overnight is the economic minister, Robert Habeck in Germany, has reassessed the economic expectations. He now expects the German economy to shrink 0.2% this year, previously calling for an expansion of 0.3%.
Yeah, I think this is particularly worrying, isn't it? Germany being perhaps the leading Eurozone economy, things seem pretty poor there. And what you're seeing, not only in Germany, but I think we're going to come to talk about the situation in Switzerland. There's a general lack of demand in Europe, and manufacturing seems very dire. So I think one of the things that's very much worth paying attention to here are power prices. Germany being one of the most significant economies in Europe to look at for power. We've been seeing a gradual sell-off in German power prices. So the German futures, as the graph here will show, has been trending down over the past month. We're seeing, it makes sense from a domestic perspective why this demand would be lower. And if you also look at the situation in the US, if you look at the situation in China in particular, demand seems to be faltering. Perhaps in China you might see this stimulus package provide some sort of almost a bit of a false sense of demand as more money is available. But the bottom line is that demand for consumer goods, for manufacturing, is falling off. And so I think we're probably going to be entering a phase where we see power prices continue to trend down. This graph is looking specifically at the November power prices, but it might be worth looking at any calendar, sort of the Cal 25 power prices and expressing that sort of view there.
And talking of Germany, some really weak data coming out this morning. Factory orders fell 5.8% month on month. That's down 3.9% year on year. And that's really weak. And that's backed up by last week's Eurozone manufacturing PMIs. In Germany, came in at 40.6 from 42.4 the previous month. So really strong contraction there. Also, France still contracting at 44.6. And a good point, we touched on this last week. Germany, it may be really weak, the economy, but the DAX is at record highs. So again, a strong equity market doesn't necessarily
indicate a strong economy.
Absolutely.
Yeah, it's you see this decoupling quite a lot, and we were scratching our heads somewhat when the Nasdaq was performing whilst all of the US data was terrible. 6 weeks ago or so. The Chinese economy, we last week saw stocks doing incredibly well despite the underlying not looking good, and we're seeing it in Germany as well. So this is a global a global phenomenon, and it's not isolated to this one period in time as well. This has historically not been a surprise.
So with the Eurozone, we had some dovish ECB comments last week. ECB's Christine Lagarde said disinflation has accelerated in the last 2 months and that Europe's recovery is facing headwinds. We also heard Schwabel from the ECB saying you cannot ignore the headwinds to growth. A sustainable fall in inflation is becoming more likely and a clear signal for faster rate cuts. But monetary policy cannot resolve structural issues. And there's some pretty strong structural issues in Germany, particularly, and France.
No, definitely. And it's interesting to caveat this as well by looking at inflation. It's super useful in this scenario. If we were to forecast, though, and we were to see inflation perhaps rising, if we were just to look at that in isolation, that could give a muddied picture, because what you might see is a reduction in output leading to a relative lack of availability of goods, and that scarcity of goods, manufactured goods, could lead to a price hike. That wouldn't be, just because inflation would be hitting 2% in that scenario, that's not a good sign at all. For all economists out there, if you were to look at your productivity, whatever PPI stands for, your
producer price index.
Sorry, no, I'm thinking of that horrible economics graph, the productivity frontier that looks like a curve. Yep. That would be shrinking in this scenario. So yeah, it's interesting to see, and I think rate cuts are probably going to have to be one of the solutions here to not only incentivize consumption by the consumers, but to make sure that manufacturing companies are still going and producing a constant amount of output.
Yeah, and with that, we're seeing stronger US data at the end of last week, weaker European data. The euro dollar's clearly turned lower. A double top at 112. We highlighted that last week, but we've had 4-5 days now of continued moves lower every day. It's broken down below 110, and 105 will certainly be a target from here. We had very weak Swiss CPI data last week. Fell below the Swiss National Bank's projections that had come out just a couple of weeks beforehand. Again, falling import prices once again. We're seeing cheap goods coming in from China, and also, of course, led by the strong Swiss franc. The SNB will have no choice again to keep cutting rates. We have 31 basis points priced for the next meeting, and terminal rates down at just 0.36% predicted by the overnight index swap market.
Yeah, it's as we said last week, a lot of the European area, not just the Eurozone, are going to be having to do these rate cuts, and we saw Sweden cutting rates last week, etc. But yeah, I think the prediction that Switzerland's going to be cutting is it's almost guaranteed, and this is a major European economy, so pay attention.
And again, this is clearly a main driver of currencies. So what we've had is the US, the market was looking at 50-point cuts at each of the next meetings, and now that's suddenly been moved to 25 basis point cuts. So you're having interest rate differentials moving in different directions, and that's why the dollar had such a strong week. It couldn't break down the dollar index below 100, and it tried multiple times and it surged higher, trading above, nearly 103 now, but clearly breaking out and trending higher again. China's back tomorrow, actually, after Golden Week. What we've seen over the weekend, actually, Goldman Sachs, for one, calling that they'll need much more stimulus to actually break the deflation that they're in. But actually, at the same time, they're saying you have to be long of Chinese equities. They see another potential 15 to 20% upside from here. But one thing that's been clear as well is there's many quant hedge funds facing more margin calls after the huge surge we had in Chinese stocks. Of course, the market was shut for a week, so it'll be interesting to see how that reopens. We did see huge moves, though, in Hong Kong. The Hang Seng Index up 32% in 13 trading sessions alone. It's never been this overbought before. The 14-day relative strength index is at 91. Again, that's a record. And since Chinese stimulus started 2 weeks ago, the Hang Seng Tech Index is up 41%. And prop developers are up 62%. Shorts here been annihilated and unable to exit positions last week while the market shut. So again, interesting to see how the market reopens.
Yeah, it's that graph mimics quite nicely what we were seeing last week on the Chinese stock indexes with a huge spike. And it's I don't think representative of a stronger underlying, but as we say, with margin calls being made, people are going to be forced out of their positions.
And the flip side, actually, in Hong Kong, real estate market is quite distressed. Mansions in Hong Kong's luxury peak district are being discounted by up to 50%. So it'll be interesting to see if we see any impact here from all the stimulus measures and surge in asset prices over the last couple of weeks. Onto the UK. UK shop prices are edging closer towards deflation territory. And a dovish central bank governor, Bailey, came out last week in The Guardian saying he sees chance of more aggressive rate cuts. But actually, the UK is the one economy where we're not seeing the huge weakness in ISM. And the PMIs came in at 51.5 last week. So the UK economy's hanging in there, which is a surprise after Brexit.
Yeah, I mean, it does look like more rate cuts are likely, but it's not as immediate. So if you're planning your holidays abroad, perhaps now would be a decent time to go and exchange your currency.
In fact, the UK, the overnight index swaps only pricing 110 basis point cuts by the Bank of England over the next 12 months, 141 though by the ECB. So you can see a big difference, divergence here in market expectations. And onto the oil price, a big week in oil.
Yeah, it's been pretty crazy. Obviously, there's been a lot that I'm sure you've all seen in the news about the ongoing situation in Israel, in Palestine or Gaza, in Lebanon, and the involvement of Iran in all of this. We've seen some huge moves in very short periods of time. One of the things that is always worth bearing in mind is that headlines can really, really influence things. If you were to look at the situation from the outside, it does appear to be escalating continually. Sides on both sides taking action against each other. Now, the real impact on oil is if things were to escalate further, going to be quite significant. If you look at Iran, they are a huge producer of oil and of bunkered products, etc. So if things were to escalate and we would see retaliation from Israel targeting Iran's oil infrastructure, that would have a damaging impact on the global supply of oil, which would see price increases. It was, I think, was it Wednesday or Thursday when the headline came out from Biden that, quote unquote, we are discussing Israel striking Iran oil facilities. We saw Brent flat price in the prompt jump $1.50 within a minute. This perhaps wasn't the best headline to buy into. If you actually watch the supposed quote, he was exiting a building and a reporter puts the words in front of him, "Are you considering striking Iran oil facilities?" To which he replies, "We are discussing it. and then he sort of mumbles something else. I'm not sure that this is necessarily representative of the US foreign policy. We all know that Joe Biden is not going to be running for president again. Many question whether he is actually, the extent of his authority in the current regime. So I'm not sure that this is representative of a Israeli-US coalition targeting Iranian oil facilities. However, the point remains, war in this part of the world, it gets so many different countries involved. It can really, have a very bullish impact on crude, and I think, it's TBC where crude is going to be in the next month or so. But yeah, I mean, here's to hoping that things don't escalate too much further.
It's something I find interesting in the oil market. My background was trading rates, FX, and there when the data's coming out, when ISM's coming out, this Wednesday there's a 10-year bond auction, when payrolls are coming out. But the oil market is much more headline driven, and it's taken out of context. This Biden, it was, as you say, he kind of stuttered at the end, and all of a sudden we had a $1.50 move rally higher in oil price. And you can see from the chart that we talked many times about the key support level at 70.5, and the market several times kept bouncing off it, even back a year and a half, 2 years ago. We thought we'd broken through it in the last couple of weeks. We know that the market has its biggest short position ever in oil, and all of a sudden, again, market positioning is crucial. You can see here how the resistance line's been broken, the shorts are desperately trying to cover, and every new headline gets reacted to even more because of the market being positioned the wrong way around.
Agreed.
On to China, interesting chart that came out of China talking about dramatic turnaround in car sales market share in China. Again, we could take this back to Germany. The German big car manufacturers are no longer selling their cars in China, and actually Chinese cars are now beginning to aggressively sell in Europe. Huge turnaround, and I don't see how that's going to change going forward until, of course, we get much bigger tariffs.
Yeah, I think that's the big question, isn't it? Are we going to be number one in Europe, as this graph has illustrated, but number two in the US post-election? Are we going to be seeing more tariffs on Chinese car exports and Chinese good exports, full stop? Simply put, if there's less demand because of tariffs, then that can reduce competitiveness of the exports. But I don't know, it does seem as though there's relatively high quality cars being put onto the streets of Europe, and there's no reason why the average consumer shouldn't benefit from this. So it's not particularly surprising that we've seen these Chinese exports increase.
Yeah, talking of tariffs, we will go into a more detailed dive into the US election next week. What's the programs that both Democrats and Republicans are touting, and also how the voting's looking at the moment. The OIS pricing, again, we've discussed quite a bit of this already, but the biggest change really last week is the US market, instead of looking for 50 basis point cuts at each of the upcoming meetings, is now looking at 25 basis point cuts. And that really has had the big impact on the US dollar. We move on to equities. The S&P is still trending higher. The risk is if it breaks below 5,670, but it doesn't look to be doing that right now. The previous high is at 5,770, a break above there, and you'll just see more money coming in. The great trading equity traders typically buy new breakouts, new highs, and we see more money piling into this.
Yeah, I think this one is worth looking at, and in the context of the payroll data on Friday, probably, supporting this idea of, actually disincentivizing rate cuts, and yet we're seeing the S&P trending higher. I think this speaks to the fact that this is a trending trade rather than looking at, interest rates falling and that leading to support of equities.
Again, equities is a great market to be long of. If you've been long over it historically, it goes...
Stocks only go up.
Exactly. it's even more important. It's a tough one to fight.
Yeah.
I've tried shorting that, and it's a tough one to short. Gold, very quickly, it's not been, the key point with the gold, it's not been hurt by dollar strength at the end of last week. You can see here in a sideways consolidation. China announced that it hasn't been buying gold now for the last 5 months, but we are seeing, well, it's not going down, even with bullish dollar news, which would typically hurt gold. This is the trade we've been touting right since the beginning of the year, and no reason to be selling it at these levels. And on to silver. Silver on Thursday briefly had its highest close in 12 years. It's not been able to close above $32.50, but when it does, again, that's another clear signal to buy the breakout.
Yeah, these safe haven trades are performing relatively well overall, even if silver isn't achieving all-time highs, or 12-year highs in particular worth noting for silver. It's been performing well.
On to just 2 or 3 more charts. The US 2s, 10s yield curve. We had been looking at steepening there. That we looked to unwind on Friday when you had the curve flattening, because the 2s is yields are going much more aggressively higher. If you wanted to hang on to the trade, it's trading at 0.2 now, just above. It's just positive. Typically, a stop loss at 20 would be good. I still think the longer term trend is towards 75. But again, in the short term, with a less aggressive cuts being priced by the OIS, 2-year yields are moving higher faster, and the 2s, 10s is flattening off the back of that. Aussie Kiwi has started to make dramatic move higher. We've highlighted this before, 4 consecutive strong up days, but you can see the interest rate differentials suggest this should go significantly higher. We have Bank of New Zealand this week, the Reserve Bank of New Zealand. Markets expecting them to cut 41 basis points, but the market's also expecting a total of 218 basis points of cuts over the next year. So I don't know why the market's expecting just 41. It'd make more sense to just do 50 now. If they're going to have to cut that aggressively, go harder sooner.
Yeah, and you know, as we've said before, the New Zealand has been it was very quick to raise interest rates, and I expect will be quick to drop them as well. So yeah, I would expect 50 basis point cut there.
A really good example of the impact of interest rates on the economy is there. Australia was slower to raise, and now the market's only just started to price cuts. New Zealand raised much harder. The economy's ground to a halt quite literally, and they're going to have to cut very aggressively.
Yeah.
Which brings us on to chart of the week. We mentioned this earlier, euro dollar clearly in a downtrend now. 112, the figure double top. It's broken below 110, and the target from here has to be 105. Again, down, it's traded down at 95 a couple of years ago, but clearly the European economy, we just keep saying it, is much weaker than the US.
Yeah, it speaks to, you know, what we've been seeing with the manufacturing indices. It speaks to our view on power. So, you know, if you don't want to express that view on power, perhaps look at euro dollar instead.
And just structural inefficiencies within government. Far less dynamic economy. So what do we have coming out this week data-wise? We have earnings this week, so keep one eye on equities. On Wednesday, we have the Fed minutes. We also have a 10-year bond auction. Now, with yields going higher, bonds selling off, there'll be a lot more interest in that. We had Stanley Druckenmiller last week saying he's gone short of bonds, focusing on the government spending. Thursday, we have US CPI. Last came in at 2.5%, expected to fall 2.3%. Also, German retail sales. Then on Friday, US PPI, Producer Price Index, consumer sentiment. In UK, we have monthly GDP and industrial production, and also Canadian payrolls. Quite a volatile week, though, with China back, headline risk in oil, and quite a bit of data.
Absolutely.
Markets will continue to trend.
It's I think it's going to be a choppy one for sure, but yeah, we'll be here next week either way to discuss how it's gone.
Good luck. Have a great week. We'll see you then. Thank you very much.
Thank you.